Welcome back. Let's do a little three-stock lunch. We're trading some key movers of the day with Michael Landsberg. He's CIO at Landsberg, Bennett Private Wealth Management. Michael, it's great to have you here. Let's start with Home Depot. After earnings trading down fractionally, they did have a third quarter beat. They expect comp sales, though, to fall about 2.5% in the fiscal year. Sales are still a little bit cautious. They're kind of coming off a tough stretch. What do you do with the stock?
Well, I think, Kelly, it's actually that number that's a decline is still an acceleration of where they've been. So we do like the story there. A couple of things we do like. They did an acquisition of SRS, which is a company in the roofing, landscaping, and pool business, which hasn't really hit the bottom line yet. That's a positive. And also, they benefit from hurricanes. They benefit from natural disasters, which is awful to say, but a lot of people are going to do renovations and things like that. Home Depot is at kind of the forefront of getting that business. And I think at some point rates go lower, and that'll also be a positive for them. So we do like the stock.
All right, let's move on to another one that begins with H, Honeywell. The shares there rising after the activist investor Elliott disclosed a $5 billion stake in the industrial giant. It's pushing the company to break itself up into separate aerospace and automation businesses. What do you think of Honeywell and Elliott's calls to break it up?
And we haven't owned the stock for probably 5 or 6 years, and thankfully it's underperformed the S&P 500 by about 50%. Wow. Part of that reason is exactly what Elliott said. They're not getting that multiple for the aerospace part of the business, which is the faster growing, more marginal business. I think with Elliott getting in, and they're not somebody that just makes a lot of bets. They take their time. They do a good research. I think it's attractive here as an entry point, given the fact that even if they don't get the multiples that Elliott's talking about, it probably has upside here if they do start to break it off, or at least they have that discussion about cost savings. I think it's a buy here. Again, we don't own it, but it's a name that we certainly are going to look at now that it's kind of breaking it up is a possibility.
Do you feel the same way about Tyson Foods? They just posted better than expected Q4 results. Somewhat higher prices actually for beef and chicken lifted revenues. What do you do?
Well, and I think Tyson's a name, again, we don't own the name. It's a name that's attractive for a couple different reasons. The chicken business has been picking up. I always thought, until I got in this business, that Tyson was more of a chicken business. They actually got more beef revenue than chicken. But what's been interesting is the beef revenues, the margins have been squeezed. The chickens kind of saved their quarter, if you will. But the other thing I think is important to look at is the success of the GLP-1 drugs, which is, the Mounjaros, Ozempics. People lose a lot of weight, but they're mostly losing muscle. And if you don't have protein to replace it, that's a problem. I think protein replacements, and obviously, chicken, pork, poultry, things like that, are good things to own. I think you could own it here for the fact that I think people have to change their diets a little bit, because if they lose the weight, they need to keep the muscle, certainly as we age.
So go for the protein and count your chickens. Michael Landsberg.